Welcome to Economics Destination. Today we explore one of the most intriguing paradoxes of modern economic history, the Greek debt crisis, and how Greece, despite near financial collapse, managed to remain within the Eurozone. We'll dissect the crisis, examining sovereign debt, EU economic dynamics, and Greece's post-crisis recovery. Let's dive in. To understand the crisis, we must first look at Greece's entry into the Eurozone. In 2001, Greece adopted the euro, benefiting from lower interest rates and increased investment. But behind the scenes, fiscal mismanagement, high government spending, and structural inefficiencies were brewing a storm. Despite the Maastricht Treaty's 3% GDP deficit rule, Greece consistently ran deficits far beyond the limit, often exceeding 10% of GDP. The Greek government relied on borrowing to fund public sector wages, pensions, and infrastructure projects, creating a dangerous cycle of debt accumulation. Government spending soared, including costly projects like the 2004 Athens Olympics, which reportedly cost €9 billion, double the initial estimate. These expenditures, along with a bloated public sector and widespread tax evasion, led to chronic budget deficits. Foreign banks and investors continued lending to Greece, assuming that being part of the Eurozone meant implicit financial stability. Meanwhile, credit rating agencies overlooked mounting risks until it was too late. The crisis officially erupted in 2009 when the newly elected Greek government revealed that previous administrations had underreported budget deficits. The real figure? A staggering 12.7% of GDP, later revised to 15.4%. Investors panicked. Greek bond yields soared, and suddenly Greece found itself shut out from international lending markets. A sovereign default loomed. In 2010, the first bailout arrived, a €110 billion package from the EU and IMF, conditioned on strict austerity measures. This led to pension cuts, tax hikes, and widespread protests. The austerity measures aimed to reduce deficits and restore investor confidence, but they came at a steep price. Unemployment skyrocketed, GDP shrank by 25% between 2008 and 2013, and public services deteriorated. Here's the paradox. Greece was in economic freefall, yet the Eurozone couldn't afford to let it go. A Greek exit, Grexit, threatened the stability of the entire euro project. If Greece defaulted and left the euro, markets feared a domino effect on other struggling nations like Spain, Portugal, and Italy. The Eurozone's survival was at stake. So in 2012 another bailout came, €130 billion, plus a private sector debt restructuring that cut Greece's debt by 50%. Yet austerity deepened the recession, with unemployment hitting 27% in 2013. Critics argued that alternative solutions such as stimulus spending or an early debt restructuring could have softened the economic blow. However, EU leaders prioritized financial stability over Greece's immediate recovery. By 2015, Greece was at another breaking point. Syriza, an anti-austerity party, took power, promising to renegotiate bailout terms. A referendum rejected EU conditions, but in the end, Greece had no choice but to accept another bailout. Despite prolonged suffering, Greece's economy slowly stabilized. By 2018, Greece exited its bailout programs. Tourism, exports, and investments began driving growth. As of 2022, Greece's debt-to-GDP ratio remains high at around 171%, but economic reforms have improved fiscal stability. GDP growth reached 5.9% in 2021, signaling a turnaround. Key reforms included pension system restructuring, tax enforcement improvements, and banking sector stabilization. While progress has been made, challenges such as high unemployment and weak wage growth persist. Greece's crisis teaches us crucial lessons. Sovereign debt mismanagement can have devastating consequences. The Eurozone's structure makes crisis resolution complex. And while austerity can stabilize economies, it comes at a severe social cost. Could another debt crisis emerge in the future? Rising global debt and economic uncertainty suggest that policymakers must learn from Greece's experience. What do you think? Could the Eurozone have handled Greece's crisis differently? Share your thoughts in the comments. Don't forget to like, share, and subscribe to Economics Destination for more deep dives into global